Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today via Zoom are Chantal Marx from FNB Wealth and Investments and Ricus from PSG Hole-in-One Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Chantal, Ricus, thanks so much for your time today. Let's start with markets. What is going on? It seemed like risk is coming back on the table after NVIDIA's results were out. Then, boom, here we are, and it seems like that sell-off is back again, and the risk on move is back to off. Chantal, let's start with you.
Yeah, so there's a valuable kind of metric of market or measure of market sentiment to look at, and that's the CNN Fear and Greed Index. And even prior to NVIDIA results, we were in fear territory. After NVIDIA results, we were still hovering in fear territory. And that tells you that the market was quite skittish. And I think it was right for everyone to be quite hopeful after that very strong print, that the capitulation we'd seen in AI stocks would kind of peter out, and perhaps we would start seeing gains again. But the reality is that the market's looking for any reason to sell off at the moment, particularly as it relates to tech. And we've now moved into extreme fear territory. And the question now is, are we getting brave enough to start pulling the trigger again and investing at lower levels, or will this persist in the weeks ahead?
And just looking at NVIDIA's numbers there, Ricus, blockbuster numbers as usual. We are still seeing some pain in China on the back of those export restrictions. Is that market still a viable one under the current circumstances, Ricus?
The Chinese market?
Yes.
I think I've got a long-standing view that the Chinese market is not investable, but it's very tradable. It's not investable because I don't know what Xi Jinping is going to do tomorrow. But if you want to trade it, I think it's cheap. Specifically, if you do a comparison with company-wise with its peers in the US, so you can certainly make the case that there's better opportunity. But be aware that politics has such a huge influence, and specifically one person, that you can be caught on the wrong side of the line at any moment.
All right, from US tech to a local player that's heavily invested in the tech e-commerce industries, Naspers. Question here. I bought Naspers when the shares split. Now I am down 500 Rand. And it's still dropping every day. I cannot believe that share is performing so badly. Should I be worried, Chantal?
I think it's very important when you have a share split or a share consolidation to instead look at your absolute overall position, the total position, because the share split will make the share price lower, but you will have more shares in your account. So you have to look at your total exposure. I think without having the detail around that, it is very difficult for me to give an opinion on what has happened in that specific portfolio holding. But from where I sit, the last few months has been very, very strong for
Naspers,
both Prosus and Naspers. So I would assume that he would actually be in the money. He must stop looking at the share price, look at his overall value, because he now has more shares to play with.
And just looking at Naspers Prosus, we did get a trading update this week, reflecting on that update. The group, of course, expecting to deliver stronger earnings thanks to upbeat growth in revenue and profitability of its e-commerce businesses and investments like Tencent. So maybe the viewer just has it a little wrong at this point, Ricus?
Yeah, I mean, at the moment, the share price of Naspers Prosus is subject to the sector rotation out of AI, artificial intelligence, tech companies, which is, as Chantal has said, sort of continued even yesterday with that reversal we had in US markets. So that's part of the macro picture. Their Naspers Prosus update was positive. I think Prosus has actually scaled down their forecast earnings a little bit. And seeing that it's still hugely dependent on Tencent, Tencent came out with results this morning, which was very good, gaming-wise, and, like all these tech companies. So it was a good result, whether it was good enough in current market circumstances.
Yeah.
With the negativity we are seeing in that space, not too sure. Price down about 2% this morning.
Yeah.
That's the 10-cent share price. But longer term, I'm still comfortable with Naspers and Prosus. Just watch out for the Chinese component.
And on that, maybe let's move over to Mr. Price, right? A viewer here asking whether they should dip their fingers into Mr. Price just on the back of yesterday's interest rate cut. We did get numbers out from Mr. Price as well. I think profits were up 6.5%. Obviously coming through in an environment where consumers have limited disposable income, Chantal.
Yeah, so I mean, it's a very interesting space at the moment, South African clothing retail, because they are competing quite heavily with the likes of a Shein and a Temu that has to an extent started eating their lunch. Additionally, as the Foschini Group told us, they're also competing for consumer share of wallet with these online gambling businesses. So they're in a tough space. There are some tailwinds though. Lower inflation, lower interest rates are generally quite positive for consumer discretionary spending. And the likes of Mr. Price and the rest of the guys in this sector should benefit from it. I think the valuations look quite compelling at the moment. And if you are wanting to look at discretionary retail, Mr. Price and Pepkor would probably be the ones that stand out to me, just because of where they're playing, what market segments they're playing in. And I mean, in the case of something like a Pepkor, that fintech angle is also quite attractive.
Yeah, and I think, Ricus, you've punted Pepkor before. I think it's one of your faves in that space.
It is, and Mr. Price would probably be my second choice, and only because it's most of its sales is in cash. So in that sense, there's quicker flows, if I can put it that way. But I still prefer Pepkor, and I still think Mr. Price, they don't really have an online presence, and that's where that's where the world's going. They're moving into fintech, but Pepkor is ahead of them as far as that's concerned. So it really is a second choice, but not a bad second choice.
Okay, all right. Let's look at diversified miners, with one of our viewers saying they're down 12% on BHP. They also hold Glencore and Anglo at a profit. The question reads, should I dispose of one or one of the three of the stocks that he currently holds, Ricus?
It depends on what the total exposure in that sector is to his total portfolio. If you're heavily overweight in resources, then obviously you've got to take a look at trimming. And he's got what, Billiton, Glencore, and what was the third one?
Anglo.
Anglo.
Yes.
Yeah, it's a different mix of product and that they mine and sell, plus also different operational management styles. Where Glencore is a trader, and the others, whether you're going to play steel or copper. So I would. So at least you getting a diversification in terms of product, as I said, and management style. So if he's worried about it and it's a huge part of his portfolio, then I would tend to say, well, reduce each of the three, but at least you're getting some diversification within that space.
Yeah, diversified picking from the viewer there, Anglo, BHP, as well as Glencore, really operating different kind of businesses and different exposure to metals. Your views on that, Chantal?
Yeah, I mean, I think the diversified miners are very interesting prospects at the moment, because both of those three names, all three of those names are heavily exposed to copper, which we know is a very important future-facing metal and is going to be quite vital in the energy transition and also empowering AI. So you would benefit from having that exposure through all three. Iron ore, the other big one for Anglo and for BHP specifically, really quite dependent on a reignition of growth in China, which I won't take completely off the table. But I mean, Ricus has mentioned, things can be a bit topsy-turvy on the Chinese front. In absolute terms, though, demand for iron ore should continue to increase as global growth increases. So I think that is that gives me a little bit of comfort there. Valuation, none of them look particularly expensive. I think perhaps the only kind of red flag for me at this point in time among the three would be Anglo American, because they are going after a pretty sizable merger. And we know what happens with big mergers and big acquisitions. So that would probably be the one that I would be a little bit more cautious on at the moment.
Let's start with Blue Label. The viewer is saying they've never had the courage to buy Blue Label before, but now with the price coming down, is it a good entry level since the imminent listing of Cell C is on the cards, Ricus?
I don't know. There's such a lot of noise surrounding the MDM listing that I would rather, I'd rather wait for that to die down. I mean, as far as I can see, it's not a company I've been following closely, but apart from Cell C businesses in Blue Label, it's pretty low margin stuff. So you need a good revenue picture on that to make money out of it. And Cell C is obviously the main story at the moment in its asset light cellular provider space. But as I said, there are other things to get involved in rather than the intricacies, as far as I'm concerned, of Blue Label / Cell C.
Hanging 10, Chantal, and waiting for the Cell C listing, or would you get into Blue Label?
So I would actually not get into Blue Label, but I would get into Cell C because they just announced that the offer price is going to be even lower. The listing price is going to be even lower than the offer range. So that would put them on like a 5 times forward PE. That is not expensive. And I think that they have a lot more to offer than what meets the eye. So yeah, I mean, I'm actually quite interested in Cell C and trying to participate in the offer. Well, you only have until the end of the day.
Oh gosh.
But maybe buying it in the market when it lists next week. So I think that direct exposure makes a lot more sense to me right now.
And let's get your views around Cell C, Ricus, and whether you see value there against some of the other telcos operators. We got Telkom also out with results recently, doing fairly well on that front, particularly when it comes to the prepaid market.
Yes, that sector has been, on the industrial side of things, probably the best performing sector this year. It's gone sideways for about 2 or 3 months. Then both MTN, Vodacom and Telkom came out with results still very good. Prices have picked up. Telkom specifically I'm interested in because they still have a lot of runway, if I can use the cliche, to do things better. MTN has done very well because Africa did very well for them. That could change tomorrow and they won't be doing well. Vodacom has had a great result in Egypt and good for them on that part, but it still is very country specific. The South African market for cellular services, I think, is reasonably ex-growth at the moment. So you've got to take a look at things like Cell C, which is an asset-light, different kind of model.
Yeah.
Or as I said, Telkom, which is still in the process of really reinventing themselves.
And then just on that then, what's your top pick out of those telcos operators, Chantal? Putting you on the spot a bit?
Yeah, I mean, you own them for different reasons, right? So I think Vodacom for slightly more steady growth, and then that optionality coming through from Egypt that has just been such a great performer, as well as Ethiopia potentially continuing to scale up. MTN just for the absolute scale on the African continent, and things looking a lot better, particularly in Nigeria. Telkom for that continued kind of momentum from the restructuring, and Cell C for the differentiated operating model. I think kind of if head on a chopping block, Cell C would be the cheapest right now.
Yeah.
But I'd feel the safest sleeping at night having Vodacom in my portfolio.
All right, let's move over to Old Mutual. What is happening at Old Mutual? Is it going slowly nowhere? You know, I was chatting to a technical analyst earlier in the week, and they were punting Old Mutual, saying that there's more room to run when it comes to that share price. Are you seeing value there, Chantal?
Well, it's certainly the cheapest of the long-term insurers in South Africa at the moment. I think they've rejigged their strategy. They've got a new CEO who has a pretty substantial reward at the end of the next 5 years if he delivers. So, yeah, I mean, I think that there's still growth there. Would it be my preferred pick in the sector? Probably not. I think you've got Sanlam with much higher quality earnings, and probably a slightly better growth profile given its ex-South Africa exposure. But I can see the investment case and the fundamental investment case for Old Mutual back. Analysis.
And are you seeing value there, Ricus? We also know that Old Mutual has launched the bank as well.
The bank is the joker in the pack. If that goes well, then the life side of businesses, where, let's face it, Old Mutual hasn't really been performing that well when compared to its peers, can be forgiven. With, as you mentioned right at the start, with the new CEO and the targets that he's been set, you know, maybe a small improvement in the life business can have an outsized influence on market sentiment towards the company's life businesses and share price. But I think it's the banking one that is interesting. So at the moment, I am not buying Old Mutual, but it has become far more interesting than it was, let's say, 2 years ago.
So one to watch. Would the panel recommend holding Reinet in my portfolio? Their view read the financials that were released earlier this week, Ricus.
Well, it's going to be mostly cash one of these days. So it's pretty safe in the current very short-term market volatility, because you are essentially sitting with a cash vehicle. And then the interesting bit is what the Raubex are going to do with it into the future. So in that sense, if the viewer's position is not sort of burning a hole in his pocket or giving him sleepless nights, I think it's an interesting one to hold, and let's see what happens over the next 3 or 4 months.
Sitting pretty there with all the cash, Chantal. One you're holding at the moment, one you think one should hold?
Yeah, I mean, I think that it made a lot of sense to take a bit of a speculative position there when they announced that Pension Corp sale. And I would probably still hold on to it for now. Yeah, I don't know if it's going to be super exciting to create a new position, given that it's going to be 80% cash from early next year, but it's going to be 80% cash that you're potentially acquiring at a 20% discount. And given a potential holding period that is less than a year, that could be substantial upside, and quite safe upside as well, if they decide to wind up that vehicle. They could also then again decide to make a new big investment. And we remember how obscure Pension Investment Corp felt when they made that investment. And Reinet actually came under a lot of pressure because investors didn't necessarily see what they were seeing at the time. They were, of course, right, and investors were wrong. But there's a risk that happens, that they don't wind it up, that they make a big acquisition, and then you could suffer short-term losses.
Yeah. A question here on Datatec and whether the company's share price has been fully price. I think I'll give this one to you, Chantal, because I know you have interest there. An ICT counter on the local markets.
Yeah, I mean, it's listed on the local exchange, but it has very little exposure to South Africa. It mainly operates in Europe, Latin America, and the US to a certain extent. And I think they're in a very interesting spot, because what they're effectively doing is they're linking the hyperscalers and the cybersecurity providers with enterprises, and then offering services while these companies are trying to integrate AI and scale their digitization process. So they're really helping out. They are tilted a lot more towards annuity income streams. They're quite diversified in terms of the partnerships that they have. There's not like major vendor risk there. And the share doesn't look expensive to me. I mean, it's trading on kind of low teens multiples, offering a really attractive dividend yield. I actually think it's a really nice one to add to your portfolio right now.
And I want to give you a different one, Ricus. A question coming in a minute ago with the viewer asking whether you'd rather buy CMH or Motus.
Okay, just quick on Datatec. That was a stock pick of mine on their results. Upside to about 82 Rand, and I agree with Chantal. It's a great story. CMH Motus was my stock pick a few weeks ago. I prefer. I think either one of them. CMH for its historic track record as far as management is concerned, Motus for the turnaround aspect of it, where they are getting their mix right, and considering where they were, even 12 months ago, seen in the bigger picture of what's happening with the South African motorcar market, where sales are still looking great. And I think Motus is also a little bit more tradable. So in that sense, I prefer Motus because, again, of better avenues of growth going forward.
So you've taken us through some of the counters you've picked as your stock pick before, but I'm hoping today you have one that's totally different. Where are you seeing value at the moment, Ricus?
Well, I was scratching around because in a market like we have, you could have 4 or 5% down in a day.
Yeah.
You look like an idiot. But Argent came out with results this morning. It's a bit obscure, very small company, but active in 38 companies or 38 countries, and a well-diversified portfolio of industrial manufacturing and specifically steel manufacturing. Big in the UK, expanding into Canada. Offshore operations are now about half of their operations, and everything did well, I think, apart from steel trading in South Africa. It's a company that's been consistently giving you double-figure earnings growth for a number of years now, and with acquisitions working out very well. So it's one of those obscure ones sitting at a very low price earnings of about 6 or 7, and a decent 3% dividend yield plus an initiation of share buybacks, which I don't like, but shareholders like that, so I'm not going to argue against that.
And let's get your stock pick. Chantal, where are you seeing value?
Yeah, I was also scratching around, very tempted to start nibbling at some of those US tech exposures, particularly the ones that were heavily sold down, but I think momentum is still firmly downwards. I feel really good about SA Inc. at the moment. And one of the areas where we've lacked from an SA Inc. perspective has been gross fixed capital formation. I think that there's a case to be made for a really nice increase in investment, both from the public and the private sector over the next 12 to 36 months. And who would benefit most? Construction. And within that construction basket, Raubex is just the highest quality. They're already seeing really strong contract growth coming through from Sunrail. And I haven't seen that share price react to the fact that they've got preferred bidder status at Lebombo border post. We know what Beitbridge did for that company from a financial perspective, and I think there's potential that Lebombo could do the same over the next few years.
So Raubex and Argent, ones to look out for. Chantal, Ricus, thanks so much for your time this afternoon. Now that was Chantal Marx from FNB Wealth and Investments and Ricus Reinet from PSG Hole-in-One Ruimsig.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.